You're diversified across stocks and bonds, but are you solving the right problem? Or instead, are you creating another investment pitfall to stumble into? That is part of Frank Vasquez's claim, and he's joining us today on this episode to talk about a possible solution, so-called risk parity portfolios.
Welcome to Personal Finance for Long-Term Investors, where every episode teaches you personal finance and long-term investing in simple terms. Now, here's your host, Jesse Kramer.
Hey, welcome to episode 144. I'm Jesse Kramer. I'm a financial planner. I work with retirees. I also work with busy professionals getting ready for retirement, and you can learn more at planwithjesse.com. Thank you to Unflappable85, who left a 5-star rating and a kind review on Apple Podcasts. Unflappable85, feel free to drop me an email to jesse@bestinterest.blog, and I'll get a super soft podcast t-shirt mailed to you. I don't have a big monologue today, everybody, just a short monologue. I really do believe in investing in knowledge. An investment in knowledge pays the best interest. And today's guest, Frank Vasquez, he knows a lot about investing and retirement planning, but his personal investment approach is relatively new to me, and I suspect will be new to some of you too. But Frank's approach is founded in reason and logic and good data, so I find myself really intrigued with what Frank has to say. And then whether I pursue his ideas in my own investing life, whether I pursue them or not, well, that's a different question. I really do believe in Warren Buffett's advice that you do not need to swing at every single pitch that's thrown your way in the investing world. So whether we swing at Frank's pitch today or not, that's up to us. But what I do think is that risk parity portfolios are an intriguing pitch, to be sure. And in the interest of sharing knowledge with all of you and learning more myself, I'm really glad that Frank accepted my invitation to join us today and explain the why and the what of risk parity portfolios. Frank, so we're going to have a fun conversation today. And before we talk about exactly what risk parity investing is or risk parity portfolios are, I kind of wanted to ground us with why. Meaning, there are other portfolios, other investing styles out there that presumably will help people achieve their goals eventually. But maybe, and this is where I don't want to put too many words in your mouth, maybe those other portfolios aren't exactly solving the right problem. And so the question to you is, why risk parity portfolios? What's the problem that they solve the best that kind of has led you to investing in them and teaching so many others about risk parity investing?
Yeah, I do think we need to start with a really big picture goals here, because this will inform the decision-making process as to why do this as opposed to something else and what the real options actually are. So in my mind, the goal of retirement is to maximize your well-being for the rest of your life. It's kind of a big, vague goal. Fortunately, we have a lot of research now as to how to go about doing that. We have books like The 5 Regrets of the Dying, which is the Charlie Munger version of that, the inverted. I mean, when you're talking about money specifically, then the question becomes, well, how do we use our retirement money to maximize our well-being for the rest of our lives? And there's good research on that about how to spend money to improve your well-being. This comes from the most easiest place to find it is in Daniel Crosby's relatively new book, Soul of Wealth. He's a psychologist, well-respected, works for Orion, which supplies lots of financial advisors with content and services. So according to that research, and he's quoting more other research, there are basically 5 things you can spend money on to improve your well-being. The first one's just the necessities of life. So we can just put that one aside. With this, obviously,
food and shelter, basically.
Yeah, food, shelter, clothing, whatever you think is necessary. If you think you need a Mercedes, maybe that's part of your necessities. But for most people, it's probably more on the food, shelter, and those sorts of necessities. So beyond that, though, there are 4 other things you can spend money on that will improve your well-being in life. One is on relationships. That's the number one. If you read any book about living a good life, they all come back to, if you had good relationships, even if you were dead broke, you'll probably look back in your life and say, I had a good life. So facilitating better relationships is number one after that. The next thing you can spend money on is experiences, and in particular, 2 kinds of experiences. One that would put you in some kind of a flow state. I mean, you just really love doing this. You're a runner or a biker or you're a creative, any sort of thing that you just love doing just for the doing of it. But then also experiences that facilitate relationships as well, that you're doing with other people. And that you can get both at the same time if you're like singing in a choir or playing in a band. Those sorts of things will go to that. So you can spend money on those sorts of things. The third one is buying your time back. Essentially paying other people to do jobs you don't want to do. We have people that clean our house now and people that do the lawn. There are a lot of things I don't like doing. And it's going to be different for other people. So like my wife loves to cook. And that's part of her experience and flow state by picking out food, cooking it, and making new things, all those sorts of things. For some other people, they really hate that. So maybe they outsource more of that and they like to go in their garden and work. But the principle there is, let's look at my life and think about all the things I really don't like doing. And let's see if we can use money to get rid of that and buy our time back. And then the fourth one is giving money away. Red Hot Chili Pepper 5. And that also comes in multiple forms. Charity begins at home, so it actually can start with family, whether those are children. In my experience, I support our parents, my parents. You can use money that way, or you can actually give it to formal charities or work with charities. So in my case, I will combine the relationships and the charity together because I'm on the board of a charity and it serves hungry and homeless people. And that also involves the podcast. So I'm integrating all of these things and spending some money on that in various ways. And that improves my well-being. Then we need to talk about, well, how is retirement funded? We want to fund all of these things to improve our well-being, all these 5 things. And so if you look at the ways you can fund a retirement, there's basically 3. They're hustling, hoarding, and harvesting. 3 H's. Hustling is a very popular activity now in fire communities. It's less popular than people think because we over-index on people creating content and putting it out there.
I was going to say, some of the loud voices are hustling.
They tend to over-index on hustling. So they're, creating courses, they're getting sponsors, they're going to FinCon, learning how to do all that. But it's essentially, you keep working in some thing. There are advantages and disadvantages to hustling because obviously you're not buying your time back. In fact, you're giving more time away to get money. So in order for it to be actually worth your time, you have to get more out of it, out of the relationship side or the flow state side of it.
Right.
Some people are serial entrepreneurs. They just go from one thing to another. Grant Sabatier is that kind of person. And so they get value out of that as an experience and out of the relationships and probably less out of the money. But some people are using that to support their retirement. So as part of their retirement funding, they are hustling. They're still working for money in one form or another. The next way you can do it is hoarding, which is the way traditional personal finance works. Traditional personal finance, the goal is to accumulate, but then when you've accumulated enough, you just keep accumulating. And you can define this numerically. Essentially, if somebody is spending 3% or less of their accumulated assets and invested assets, they're essentially adopting a hoarding strategy. Because if you do that, it really doesn't matter that much how you've invested. You can hold a 30-year tips ladder, you can hold an 80-20 portfolio, you can hold just about anything you want and do it on base of personal preference within reason. Because the strategy is not what you're doing with your assets. All that affects is how much is left when you're dead. The strategy is just to underspend the portfolio and in many cases, the model is to reach financial independence, but then work a decade longer so you have at least twice as much as you need.
And we can come back. I definitely want to touch on safe withdrawal rates later, but some of that hoarding is either a function of traditional safe withdrawal rates being over conservative, or maybe traditional safe withdrawal rates having such a wide range of outcomes that the conservative end of it is really conservative. And that's probably just also combined with people's loss aversion, right? A lot of us are biased for loss aversion.
It's a preference. But both hustling and hoarding are preferences.
Our preferences.
Our personal preferences that are implemented.
And don't necessarily maximize those 5 pillars that you were just discussing a few minutes ago.
The hoarding can cause big problems with a number of these things. Particularly on relationships. Because people get reputations and their spouse may be very upset about them not spending the money on whatever they want to spend the money on, whether it's a new hot tub or a camper or whatever, this does also cause problems with parent-child relationships. There is a great researcher and provides services, a guy named Jim Grubman, who specialized in really wealthy families and managing family wealth. And he talks a lot about this, that a lot of the practices that people use, which are, I'm just going to squirrel all this money away and I'm not going to tell anybody about it. Oftentimes, the children will find out that they've been living a lower lifestyle than they needed to, and they find it out when they're about 40. And it really creates a horrible rift between the adult child and the parent, because the adult child is thinking, you made me work through school when you could have afforded to send me to college and things like that. So hoarding over long periods of time can be very detrimental to personal relationships, particularly at the family level. You're choosing to overaccumulate and not spend the money on something that somebody else thinks would be important to spend money on in terms of family dynamics.
Put a pin in my devil's advocate argument here, because I have a feeling you're going to come back and address this later. But what if the elder family member responds to what you just said, Frank, and says, well, I'm worried about running out of money. I can't give it all away to you while I'm 70 and my child's 35, because here I am at 70. I might live till 90. I can't be giving it away right now. Do you want to come back and address that concern later?
I mean, the short answer is, well, yes, you can. You're just choosing not to. You're conflating a can't with a I don't want to. And often at times that's based on some scarcity mindset, based on your childhood experience or other prior experiences. So basically you're reliving past experiences.
Money scripts.
Yes.
Money scripts.
I just heard a podcast from Schwab. It's called Choiceology. So it's about decision making. And it was about Groucho Marx, who speculated a lot in the 20s, lost big time in the Great Depression, and then became a miser after that.
Interesting.
And it did cause problems with his personal relationships with his family.
Yeah, I could see that.
And the reason was based on that experience. And that they were saying this is a cognitive bias where based on some experience, you are behaving in a way that is not the best way to behave later on because you're reflecting on this prior experience, but they're not related.
Yeah, that mental scar tissue, it seems it's probably ever present. We all probably have it. And one of the hard parts is most of us are probably unaware. I probably have mental scar tissue that I couldn't define for you, Frank. But someone who's not me and observes me for a few, I don't know, days, weeks, months, years, could probably be like, yeah, Jesse, you've got some scar tissue you need to work through, whether it's financial or not.
Well, yeah, that's why you don't want to hoard the money. You want to spend it on a therapist.
Right.
But by definition, you are not using money for those 5 things, or you're using less than you could.
Yeah.
So you are not maximizing those things.
And does that bring us to harvesting, the third H?
Yes, we will. Harvesting is simply getting the money out of your accumulated assets. And so if you are more efficient at that, then you can spend more money on these 5 things to improve your well-being, because the other 2 choices often conflict or cause problems with that. Whereas there's almost no problem with harvesting unless you over-harvest, obviously. That is actually extremely rare for somebody who has had the wherewithal and conscientiousness to actually accumulate enough to retire with. Those people are not running out of money. Financial advisors, so Michael Kitces and everyone else is reporting the same problem is the opposite problem. Nobody's running out of money. When Dana Anspaugh was asked this question, have you ever had a client that ran out of money? She had one, and it was basically somebody who was clearly overspending. They told them they were overspending, but they continued to do it anyway. It wasn't like there was an emergency arose and there was long-term care and they ran out of money, or all of the big bugaboos that you hear about in reality are not causing people to have problems. The chances of you over harvesting, if you have any reasonable plan, are very low. So the kinds of people that I am dealing with and speaking with are very averse to hustling. They want to harvest. Some of them have look at their situation and say, I think we're hoarding and we want to give away more money. We want to do more things with our money. We want to start giving it to our children earlier on. We have charitable desires. I've thrown out a good goal, I think, for well-being in terms of giving money away would be to give away 1% every year that you have in your mind. I have 1% that I'm going to spend every year on other people. And whether that's formal charities or your kids or...
And that's 1% of your net assets, right? That's not 1% of income.
Correct. It's 1% of your net assets. So we spend 5%, which I divide up into necessities or keep the lights on stuff is 3%. 1% is what I would call comfort expenses, to pay the people to clean the house and do the yard work and buy the gym memberships and all the nice things, go out to eat, take vacations. And then the remaining 1% is for extravagances and giving away, basically. So we were using part of that for renovation this year. And a lot of it since I've been supporting my parents for 15 years, a lot of it's been going to them. They've lived a really long time. They're actually celebrating their 70th wedding anniversary in June.
Wow.
My father's 97 years old.
Wow.
And my mother's 92.
Well, you've got some good genes. And longevity is a real factor in retirement as well. Here's a quick ad, and then we'll get back to the show. Hey listeners, Jesse here. My team and I are preparing for episode 150 of the podcast, which we'll be recording in a couple weeks, and we thought it'd be fun to do an Ask Me Anything episode. And many of you know that my normal Ask Me Anything episodes focus entirely on retirement and financial planning questions. Well, we want episode 150 to be a little different. We're going to open it up to just about anything. Ask me anything you want. And I'm not slipping down the slope of becoming a self-absorbed influencer, but we figured, once every 150 episodes or so, it could be fun to share a little more than tax rates and expense ratios. So if you have a question, ask me anything. Simply send an email to jesse@bestinterest.blog. Thank you. So let's pivot and now talk a little bit about the what. Let's ground the audience with the typical constituents of one of these portfolios that you put together. And I've been calling them risk parity portfolios. You host Risk Parity Radio. I know that the nomenclature itself is somewhat a little bit gray. And so feel free, if it's worth going into the nomenclature itself, feel free, Frank. But more importantly, let's define the asset classes themselves that build up one of these portfolios.
You start with stocks and bonds.
A good start.
Just like everybody else.
Classic start, we could say. Yeah. Yep.
Just like everybody else. The way I would describe a portfolio that I'm building, it's like if Bill Bengen and Ray Dalio had a baby portfolio.
Okay. And for the listeners who don't quite know Bengen and Dalio, 10 seconds on each. Hey, listeners. So we didn't end up coming back around to talk about who Ray Dalio is. So I'll do that here. Ray Dalio is the founder of Bridgewater Associates, which is the world's largest hedge fund. And it's made famous. He's famous for his concept of the all-weather portfolio, essentially a really big risk parity style portfolio.
Yeah. Okay. So Bill Bengen is the father of the 4% rule, who had came up with the original concept back in the 1990s, but then has improved on it over the past 30 years and has done a lot of research showing what kinds of portfolios tend to have higher safe withdrawal rates, and therefore you can harvest more out of them. So we use a lot of his research as guidelines. And he recently wrote another book which summarized a lot of the work he had done in, say, the past 20 years. Bengen 1.0 was very helpful, and is what I started with when I was working to build this up back in like 2010. But Bengen 3.0 is really good and it has a lot of good guidelines. So a couple of guidelines that come from him are have less than 10% in cash or cash equivalents or short-term bonds, or whatever you want to call those things. Because if you have more than that, it starts to drag down the long-term perspective. You end up with a cash drag in your portfolio.
Does that typically include an emergency fund, that 10% number?
I would say when you get to retirement, you don't need an emergency fund anymore because you make that part of your overall portfolio.
Got it.
By definition, you're spending money out of your portfolio. So you need to account for that. What is invariant there is it does not matter how you organize this cash, whether it's in ladders or in savings accounts or short-term bond funds or whether you put labels on it and say bucket 1, bucket 2, bucket 3, or it's just one allocation. It doesn't matter. The rule stands no matter how you do it. He observed this back in the 1990s and he's retested it, and everybody else who's done this kind of research sees that. The next guideline he's come up with that shows for higher safe withdrawal rates is that the stock portion of the portfolio typically needs to be between 40-some% and 70-some%. And what he's found is it's kind of a mesa that you go up when you get to 40-some% and it stays high, but then it drops once you get up to into the 70s and have more of an accumulation kind of portfolio that's like 80 to 100% in stocks. The more recent research he's also done on the stock portion of this shows that you need to diversify out of just large cap focused funds. Mm-hmm. You can't just have a S&P 500 or a total international large cap focused thing. You need a few other components of that. We can talk about that a little more in a little bit. And then in terms of the bond component, it should be treasury bonds because they are the most diversified from stocks of all the kinds of bonds. And actually, you want to minimize the number of bonds you're actually using. So having like 40% in bonds is too much. It's not helping you because bonds are a low yielding asset. And you're not holding them there for yield or income or anything else in a portfolio like this. Basically, the sole purpose of them is a kind of recession insurance. So when you get the 2020 or the 2008, you have something that is going up in capital value in your portfolio when you know the stocks have an 80 to 90 or 100% chance of going down.
Correct or addend what I'm about to say here. You are looking for assets that perform differently in different economic environments.
That's correct. That is really why things are correlated or uncorrelated. I think there's a perception sometimes, and maybe it's just people misspeaking or kind of speaking in truthiness, that correlations are random or we don't know what's going to happen in the future. Therefore, we don't know what the correlations will be. And when we don't know. Yes, you do. We know this. There's rafts and rafts of research on this. And what we know is that if you know what economic environment you're in, if you're in a recessionary environment, growth falling, inflation falling, or in a deflation, bonds are going to perform, treasury bonds are going to perform well, and stocks are going to perform poorly on a probabilistic basis, like 100% of the time or close to it. There are basically three other economic environments that are typically talked about in this context. This is often called a 4-quadrant model. So you can have increasing growth or decreasing growth, and then increasing inflation or decreasing inflation. Most of the environments are fairly friendly to the stock market. If you have some kind of positive growth and moderate inflation, that's a good environment for this. That's a Goldilocks environment. Everybody likes it. Stocks go up, bonds do fine, or they don't do anything. And that works very well. Where you really have problems is in a stagflationary environment like 2022 or high inflation and low growth. Typically, when you get out to the very high or very low inflation, that's where for instance, you see stocks and bonds become positively correlated in higher inflation environments. So we know all the different kinds of weather we can have, basically economic weather we can have, and we know what does well in each kind of weather. What we don't know is what the weather's going to be like tomorrow.
Right. and this is related tangentially or maybe directly to this whole all-weather portfolio.
That's why these things are called all-weather portfolios, because they have things in them that will, if not do well, at least help the portfolio through the worst kinds of storms, if you will. And it is all based on the idea that history doesn't repeat, but it rhymes. And so we know what the kinds of weather is that we can have, and we know what kinds of assets do well in those things. So if we combine those in a reasonable manner, we're going to have a more diversified portfolio, which then is more resilient, and you can take more money out. You can harvest more money out of it. It's eventually where you get to on that.
Let's keep going then. So starts with stocks and bonds, but we need a different type of raincoat or umbrella for some other weather conditions that stocks and bonds might not protect us from. Where do we go after stocks and bonds?
So you're looking at alternative assets, basically things that are not stocks and bonds. So let's talk about what's not in this category. Private equity, private debt, those are stocks and bonds.
Right.
Just because they're private, stocks, not debt, public, does not mean they're not subject to the same economic forces.
Right.
Or these weird products that people are referring to as like ETF swap now it's stocks with some options overlay that's paying some income or some kind of structured product or some kind of buffered thing. These things have become very popular because they're very lucrative to people like JP Morgan that create them. And they're very attractive to sell through financial advisors because they have characteristics that are easy to market. So none of those things are alternative assets in the way I would define it. To me, an alternative asset is something that has a zero correlation with stocks and bonds, a zero correlation with both stocks and bonds.
For the semi-math literate out there, because correlation can be positive or negative, Frank, but what you're saying is zero, because it's neither positive nor negative correlation, correct?
They could be moving in the same direction or a different direction from stocks or bonds. This is Ray Dalio's holy grail principle. This is just math, that if you have a number of assets that are uncorrelated and you combine them, you essentially reduce the risk of the overall portfolio without reducing the returns as much. And so you get essentially a diversification bonus. This is the whole point of diversification to begin with.
The one free lunch. It's the one free lunch, so to speak.
This is the free lunch. And so when you were thinking about, well, what does that mean in terms of characteristics and comparisons? The holy grail or gold standard here is zero correlation between whatever these assets are. So we're looking for things that have zero correlation with both stocks and bonds. I should say another thing that does not work for this is other kinds of bonds. You cannot use TIPS or some kind of corporate bond or some weird bond thing or individual bonds. Those do not work for this purpose. Those are not alternative assets. The things that do work the best historically have been gold, there's a zero correlation, and managed futures or trend following, which is a strategy that typically involves both interest rates and commodities and can involve stocks. But that is a particular strategy that it's been around since the 1970s. It's been researched back 100 years in terms of data. It's been researched to death. And that strategy actually, it used to be too expensive for individuals to use.
That's the managed futures you're saying?
Yeah.
It's too expensive? Okay.
This is when I first looked at this back in 2010. It's like, oh, that's a good option, except you got to put your money in this hedge fund and pay 2 and 20 or some, or if you buy a mutual fund version of this, it's going to be 2, 3, 4%. It wasn't worthwhile for an individual to do that. Now we have effectively, since about 2019 when they changed the ETF rules, so you can put all kinds of things in ETFs now, we have the equivalent of an index fund or a couple of index funds that do this.
Interesting. Okay.
That track something called the Societe Generale Index, SocGen, which is basically a compendium of all of the hedge funds that do these kind of strategies. What these funds do is replicate that.
Got it.
Mathematically. So it's like having an index fund that does that.
Of managed futures in a way.
Yes. Yes.
Hey, listeners, I just wanted to add some color to what managed futures are because they're the strangest asset class we're talking about here on today's episode. The big point of managed futures is diversification and crisis protection. That's why they exist. So in managed futures, portfolio managers are trading futures contracts, which are a little bit strange to understand in and of themselves, across different asset classes like commodities and currencies and interest rates and stocks in order to hedge risks, to hedge their bets, and to attempt to zig while the market zags. We know, for example, that managed futures are going to underperform during bull markets. That's by design. But we also know that they'll perform quite well during market crashes, also by design. Managed futures have a low correlation to stocks and bonds, and they historically tend to perform well during periods of market stress.
What you end up with is something that has, roughly 7 to 8% expected returns with a zero correlation to both stocks and bonds. It's very attractive for this purpose. So what I found is that if you just have stocks and bonds, Bill Bengen has been able to get the safe withdrawal rate up to 4.7%. If you add in something like gold or managed futures I would say between 10 and 25% in alternatives seems to work the best. You can get up to 5% or more than 5% on a safe withdrawal rate calculation. One of the next things he's going to do, because Bengen does hold some gold himself, is analyze that more closely. So that's coming. He's promised.
Okay.
He's getting up there in age though. So I can tell you the answer. We already know the answer because other people have done the research, but it's if you just add gold to a portfolio, it adds 0.3 to 0.5%. on a safe withdrawal rate.
On a safe withdrawal rate basis. Interesting.
Yeah. That goes back 100-year research. Actually, Carsten Jeske did that research as part of his safe withdrawal rate series number 34.
Here's a quick ad, and then we'll get back to the show. Serious question. Why do podcasters constantly ask for ratings and reviews? Yes, they do help highlight our shows to new listeners. They help strangers find us on Apple Podcasts and Spotify. It's totally true and a good reason to ask for ratings and reviews. But I have something more important, at least more important to me. I want to know if you like this stuff. I want to know if you like my podcast episodes, my monologues, my guests, the information I share with you and the stories I tell. I want to improve and make your listening more enjoyable in the process. So yeah, I would love to read your reviews. And sure, if you throw a rating in there too, that's great. If you like what I'm doing, please share it with me. It's such a great feeling to read your feedback. I'd love to read your review or see a rating on Apple Podcasts or Spotify. Thank you. Again, I'm playing devil's advocate here. Hope that's okay. I've got a copy of Charlie Munger's Almanac at home. I'm a big Warren and Charlie guy, as I know I've heard you quote Charlie at least a bunch. And they both have, or both had, that Charlie Munger's passed away, but they both had an opinion about gold. So I'll pick on gold as my devil's advocate argument here, where they'd say, gold has no intrinsic value. You have to hope someone comes along later and pays you more for it. Gold has had long periods of underperformance. Granted, it's also recently had a outrageous period of, I guess you would call it overperformance then. But the point is that, okay, I could make an argument to say that gold is a quote unquote suboptimal asset. So the question is, do I need to hold these quote unquote suboptimal assets in order to create this risk parity portfolio? Or am I just asking a wrong question? Is my question in and of itself missing the mark? What do you say to that, Frank?
Yeah, well, there's several things going on here. You don't have to, but you'll end up with something like Bill Bengen proposes, and it won't be quite as good as something that does have an alternative asset in it. So, yes, you can do that. Charlie Munger's very interesting to me because we were part of a very small club. We both went to Caltech and then became lawyers.
Oh, yeah.
And there's probably only like less than 1,000 people walking around on Earth that
are in that club
that have that characterization. What you need to know about what they do. Okay, first, what is their retirement strategy? Is it hustling? Is it harvesting? Or is it hoarding?
I see. Okay.
Their strategy is hoarding because they have so much money that they underspend. And
you're saying Warren and Charlie. Hoarding. Yes. Got it. And hustle. I mean, they worked until their death.
They hustled, but that's why Warren Buffett says, I don't want my heirs to be trying to pick stocks because they're not going to be able to do it. I would prefer them to hold a 90-10 portfolio, 90% in the S&P 500 and 10% in treasury bonds. And so that 90-10 portfolio works fine if your strategy is hoarding because you're never going to outspend it. You can have 100% in stocks if you're spending a fraction of a percent in their case because of how much money they actually have. So they don't have any need for harvesting or a strategy that emphasizes we need to get as much money out of this as we can because they're billionaires and I'm not a billionaire.
Yet.
I'm wealthy enough to have a good harvesting strategy and live a good life. I am not wealthy enough to be able to hold a 90-10 portfolio and not worry about a big market crash, which is what I cite that because that's what Warren Buffett actually recommends civilians do if they have enough money. They're correct that gold is it doesn't generate an income, but that doesn't mean it doesn't have any value. This is a place where there's a lot of Dunning-Kruger problems in retail. Financial advisors don't know this. What they don't know is this. There are many methods of doing valuation. There's a false notion that it comes from a misinterpretation of what Munger and Buffett say is that, well, if I can't do a discounted cash flow or a net present value on this asset, I don't know what it's worth and I can't value it, therefore I shouldn't invest in it. You can't do that kind of valuation. I spent 30 years working with valuation experts. There are many different ways of valuing assets, including ones that don't generate cash flows. The most common one you're familiar with is when you go buy a house to live in.
Yeah.
How do you value that? You're not doing a discounted cash flow analysis.
Correct.
And you're not saying, well, I can't do a discounted cash flow analysis, therefore I'm never going to buy a house to live in. That is effectively what people are saying when I hear them say, I can't do a discounted cash flow analysis on gold, therefore I'm not going to invest in it. That represents an ignorance in how things are valued. So in that circumstance, you would use a market value, or you'd look around, and this is what appraisers do for things like property and art and gold and everything else. That just because it doesn't have a cash flow does not mean there are not established ways of doing valuations for whatever this is. In fact, for gold itself and gold mining, there are massive codes put out. I had to learn this stuff because I had a case about a gold mine in Uzbekistan about how to value gold in the ground. People who are investing in mines and mining companies, they need to value things like gold and silver, whatever the product's going to be. They got to put a value on that. And as part of that valuation, they've developed these very detailed methodologies for doing stuff like that. You will find that's true in just about any kind of environment where something's being appraised. And it's interesting. I don't see this argument or this problem, this mental hang up amongst people who work at an institutional level about things like gold and commodities. So a good person to follow in that respect would be David Stein, who now he runs Money for the Rest of Us. He's written one of the best books for individual investors to read is Money for the Rest of Us. That's come out in the past few years. He comes from an institutional environment. He's recently recounted this in an interview. He was asked, have you changed your mind about anything? He says, yeah, after I came out of the environment, I was looking at things like gold. And in 2012, I changed my mind on the usefulness of that in a portfolio.
He became more optimistic, you're saying?
Yeah, he said, okay, I can see how this is used. That although you could characterize it as a speculation because it doesn't produce an income, that doesn't mean it doesn't have a value or a purpose. And so I follow people like that. The people that I will rely on the most are people that have come from an institutional framework who invest at the highest levels. And so they are not subject to these essentially emotional reactions to things like gold. If you read Aspirational Investor, he will tell you and show you how gold can be used for certain kinds of portfolios that look a lot like the portfolios that I talk about. Yeah. So all of this stuff, although people come up with objections to it, you really need to think about what is the background of the person that's making this objection, and do they really know what they're talking about? Because most of them don't. And if you go up a level to people like the Ray Dalias in the world, or AQR, or Ashwin Chabra, or even David Stein, who's gone from institutional to personal, they don't have a problem, a visceral reaction to assets that aren't stocks or bonds. Instead, they look at the whole. They look at what it is, how it would fit. Does it have a demand that causes it to have value? In gold's case, most of the demand actually comes from central banks, so it's an international asset. It's not, and it's had a demand for as long as there have been humans walking around using money. So that's not likely to go away.
And it's totally fair. I mean, I recognize the fact that the discounted cash flow, net present value modeling has limitations to it. And sometimes you just have to say, I've got a pound of gold sitting on my desk. Could I walk out my door and sell it for something today?
Yeah.
If the answer is yes, then it clearly has a value. I mean, because I think to myself where Buffett would be famous for his, he waits for that perfect strike. He doesn't jump at every chance. And maybe he would say, I don't understand this valuation method, or I don't trust this particular valuationist method as much as I trust the other valuation methods I use. And okay, more power to them.
Well, somebody like that has so much skill that they don't need anything other than it's like somebody who's a very successful business person, like Mark Zuckerberg or something like that. He doesn't need gold.
Right. Right. He's not listening to this podcast. I get it.
Skill in building this company, and he's got all these shares. Of course, these people don't. Yeah. It would be kind of silly for them to be wasting their time when they have these superior skills that you and I don't have. And that's what we need to recognize. We don't have these skills. That's why I'm using diversification that I can actually do as opposed to trying to be Warren Buffett, because I'm not vain enough to think I have that kind of skill. I can combine assets. That's my level of skill. In ETF form, I can do that. I can handle that. There's a lot of misinformation about gold that people circulate. How old are you, by the way?
36 years old.
So you were born in
90.
Okay. So oftentimes I hear people say, gold is so volatile. It's like 8 times more volatile than the stock market. I've heard that before. Well, what do you think has been more volatile in your lifetime, gold or the stock market?
Well, not that you're leading the witness, but I'm going to have to guess the stock market.
Yeah. And the thing is, you can look this up in 5 seconds.
Yeah, sure.
You can go to Testfolio and look up any of these assets. So a lot of the things people say are just not true. And that's a big problem. People believe and repeat things that just aren't true. They're truthy. Because Stephen Colbert says they're truthy in that, yeah, you can find a period where gold was a very volatile thing. You can also find, what would you say if I said, I'd like you to invest in this asset, but it can drop 20% in one day. Would you invest in that?
Well, it sounds like it has some risk. If that's all I know, it sounds risky to me.
Yeah. You know what that asset's called?
Stocks is my guess.
The stock market. 1987, It dropped over 20% in one day.
I've got a headline on my wall, panic.
So the truth is that gold is no more volatile than the stock market. In fact, it's been less volatile in your lifetime. You have to go back to the 1970s when it first became tradable. Even then, if you go all the way back to the data set to 1968, it has about the same volatility with the stock market. In this century, it actually has lower volatility and better returns than the stock market. So in the 21st century, gold has been a better thing to hold than the S&P 500. Will that continue? Will that change? For my purposes, I look at all of the data we have, which goes back to 1968. I can see that gold has a compounded annual growth rate or return of like 8%, 7 or 8%. It's less than the 10% you'd get out of the stock market, but it's much more than bonds. And it has a volatility that's reasonable. It's not 8 times the stock market. It's about what the stock market is. And then most importantly is, okay, so it's uncorrelated with both stocks and bonds. So I can put it in a portfolio and get that diversification bonus essentially out of it. That applied Ray Dalio's Holy Grail principle by finding uncorrelated assets and combining them. That's why it works the way it does. And that's kind of the truth as opposed to the truthy. The other thing I should caution people is, that is a long-term asset. What people are doing with gold is they're going to Costco and buying these bars and they're putting them in the ground and then they're trading things and they're doing it next month and they're trying to predict the price. It's like, no, that's just a bad practice with any asset. That we're talking about being long-term investors here. So we're talking about a minimum of a decade for holding a period and really more at least 25 years.
Yeah. This is a retirement portfolio,
yes.
right? This is a retirement portfolio.
So we need to hold that essentially forever as one of the assets in the portfolio. And you sell it high and you buy it low. So
through rebalancing.
I've held gold since 2015. And so it's doubled or tripled. I can't remember which right now. But I've been selling it for the past 3 or 4 years. We've been living on it in our retirement. Yeah. Because it's gone up the most. You sell the thing that goes up the most and buy other things. You buy bonds because they've been terrible.
That's the nature, though, of different assets performing differently and rebalancing.
That's how you're supposed to manage a retirement portfolio.
And it goes back to the 4 quadrants, the economic regimes that you kind of go through over time. We don't know what the weather's going to be tomorrow. And I've got 6 other questions I wanted to go through, but I do think that either means maybe we find time to do a part 2 in a few months, or maybe we send the listeners right now over to Risk Parity Radio, because we've only scratched the surface here today. If memory serves me, there are specific episodes that are good places for listeners to start if they haven't tuned into Risk Parity Radio before. Can you tell us what's going on?
Episodes 1, 3, 5, 7, and 9 are the base episodes that tell you where this comes from, what the history of it is, why you do it this way. I direct people there first. There are over 500 episodes now, but you can search all the episodes at the website. I had a listener that actually brilliantly redid my whole website. The whole thing is searchable now. I would say it's not for everybody. It's not everybody's cup of tea. I have about 3,000 listeners now, and the reviews are either 5-star, 1-star. This is the best podcast I ever listened to, and I love the sound clips, and it's very funny, and it's very informative. Or this is probably the worst thing I've ever heard. It sounds like it was made by a 10-year-old with ADHD.
Well, listeners, you can reach out to me or Frank and let me know what you think about Risk Parity Radio. We will put all the relevant links that you mentioned there, Frank, into the show notes. Thank you so much again for joining us here on Personal Finance for Long-Term Investors.
You're quite welcome.
Listeners, I have one parting thought today. If this episode intrigued you and you want to hear more from Frank, please drop me an email. I'll try to invite him back on the show because, as you heard me say, we only scratched the surface of risk parity portfolios today, and I'm always a fan of learning more. At this point, I still see risk parity investing as a topic that I'm learning more about. I'm open-minded to, but something I don't fully understand yet, and therefore I'm not enacting it in my own portfolios, at least not yet. My current thinking is that risk parity solves a specific and important problem. And that problem is how to dependably increase a retiree's spending, even if during bad market conditions. That's a big problem. It's important. It's what Frank was talking about when he was talking about hustling and hoarding and harvesting. But what I'm currently chewing on, though, I'm thinking about that term hoarding. It has a bit of a negative connotation, of course, but is that the right word to define retirees who feel comfortable relying on mainly stocks and bonds? I'm not sure. I think it's important to think about the words we choose and not to let the label hoarding maybe unduly influence us over the underlying behavior. Because one of my takeaways from Frank's work is this: you must be entirely comfortable with your investing strategy. If it's 100% stocks and you're entirely comfortable with that, great. If it's a traditional 60-40 portfolio and you're entirely comfortable with it, great. Or if it's a risk parity portfolio and you're entirely comfortable with it, that's great too. Maybe it's rental homes and stocks and bonds, fine. The point is, if your portfolio is something that you are not comfortable with, that is a dangerous thing. I'm still doing the work personally on risk parity portfolios, and I'm really glad to learn from Frank and others like him. I hope maybe you feel the same. So thank you, as always, for listening to Personal Finance for Long-Term Investors.
Thanks for tuning in to this episode of Personal Finance for Long-Term Investors. If you have a question for Jesse to answer on a future episode, send him an email over at his blog, The Best Interest. His email address is jesse@bestinterest.blog. Again, that's jesse@bestinterest.blog. Did you enjoy the show? Subscribe, rate, and review the podcast wherever you listen. This helps others find the show and invest in knowledge themselves. And we really appreciate it. We'll catch you on the next episode of Personal Finance for Long-Term Investors. Personal Finance for Long-Term Investors is a personal podcast meant for education and entertainment. It should not be taken as financial advice, and it's not prescriptive of your financial situation.